Hello, ladies and gentlemen. Welcome to the Money Mentor podcast with your host, Graeme Holm, aka Australia's original money mentor. And again, we have the amazing Dr. Andrew Wilson. Now, again, in case this is your first time and you've been living under a rock, Dr. Andrew Wilson is Australia's leading independent property economist, and independent is the key word. His information and his advice and knowledge and data is not skewed towards any bank agenda, government agenda, any particular organisation. I say again, independent leading economist. Now, who is Doc? What has he done? He's currently the chief economist of My Housing Market, previously chief economist of Domain Group, and a whole heap of other very well-respected organisations. Qualifications-wise, why do you need to stay tuned? Well, most of you know, but if you're not aware, Dr. Andrew Wilson holds a Doctor of Philosophy in Housing Market Economics from RMIT University, Master of Science by Research, RMIT University, Graduate Diploma in Economics, Monash University, Bachelor of Construction Economics with a distinction. He's a smart cookie, RMIT University. He's also a member of the Royal Institute of Chartered Surveyors. So I'll leave it there, because if you add all those letters up when you start going PhD, MSc, grad, he's got more letters after his name than I have in my legal 3 birth names. So good morning, Doc. How are you?
Yes, I'm good, Graeme. Good to be back here again this week. And we're well and truly through September now. And we're going to get all those football finals, the grand finals, over and done within the next 2 weeks. So it's a pretty interesting time in Australia-wide. And, of course, we've had the big news, unfortunately, of the passing of Her Majesty Queen Elizabeth II. So there's a lot of focus on that as well. But, the housing markets are alive and well. And certainly the latest results from our weekend auctions are, again, reinforcing, I guess, the premise that we've been running with recently, and that is that maybe there's just a hint of our, particularly Melbourne and Sydney housing markets, just starting to think about finding the bottom of the recent decline cycle. So all pretty exciting stuff, Graeme.
Yeah, I think, football final season is always an exciting time, but it depends who you're a fan of, Doc.
That's right.
It could be a miserable time.
Yeah, that's right. Yeah, I try to stay away from it. My team didn't do too well this year, so we'll move on quickly and talk about...
Moving right along. Back to the housing market. So, Doc, interesting last couple of weeks. You just said there that, signs that we're maybe getting closer to the bottom of this doom and gloom and huge price drops. Looking at some of the data this week that you always share with me, days on market and auction clearance rates, all of these, this data set that people listening to us now understand why we look at that. It's actually, properties are actually selling quicker than they were in some cases in cities, and auction clearance rates are really, really strong, still 60+%. So what's happening? Take us around the ground this week.
Well, we always start with the auction market, Graeme, and weekend auction results are always a good forward indicator of what's happening generally in our housing markets. Not all of our capital cities have strong auction markets, but certainly Sydney, Melbourne, Brisbane, Canberra and Adelaide do. And we know that when we track the long-term trends of auction clearance rates and house prices, that they do match each other. And we have been seeing a sort of a renaissance, particularly in the Sydney market over the past month. That continued at the weekend. The weekend before, of course, Sydney recorded a very strong clearance rate. Sometimes these weekend-to-weekend rates can be volatile. So it's important to look at the trend over the past month just to see if we're what the underlying noise is in the in housing market activity. But again, the Sydney market performed well. Auction numbers were again significantly higher than the weekend before, and that mid 60% clearance rate that was recorded the weekend before was consolidated this weekend in Sydney, Graeme, with a 65% clearance rate.
I was going to say, Doc, you got 664 sales, 65%. Last week we were at 67 and it was 603. So we had more stock on market, yet still cleared within that same mid 60%. That's pretty good.
Yeah, it is pretty good. And the benchmark with auction clearance rates, Graeme, is when we get to 65%, it's probably what we call a balanced market. So there's X amount of buyers and there's the same amount of sellers, if you know what I mean. Yep. So theoretically, that means that prices are neutralised. And once we move above around 65%, of course, we have more buyers and sellers, and that means that prices typically start to rise. If we're below 65%, it means that we've got a weaker price environment. Now, that's typical of the Melbourne and Sydney markets and also Adelaide that have more substantial auction environments. But, yeah, we are now consistently tracking in the mid-65% in both Melbourne and Sydney. And, of course, that sort of adds to that, I guess, the other forward indicators of what's happening generally in the housing market, such as days on market and prices, that we are maybe heading towards the bottom of this adjustment cycle a lot quicker than many had predicted. But those auction numbers were, again, a substantial. Of course, Saturday in Melbourne, Graeme, was Super Saturday.
I was going to say, Docs, this Super Saturday, I'm looking at the numbers going, we've jumped a couple of percent in clearance rate, but there was an extra 80 to 100 sales that went through.
Well, the weekend before the AFL Grand Final, Graeme, is typically the first Super Saturday of the year. And we get a front-end loading of auctions, of course, because sellers want to avoid clashing with the Grand Final. Next weekend, we've only got a handful of auctions in Melbourne, around about 50 auctions in Melbourne coming up. But, of course, everybody's watching the Grand Final, so there's no surprise there. So typically we get a loading up the weekend before the Grand Final of numbers. The numbers weren't too bad. Around about the 900 or 800 auction mark there, a little bit lower than recent pre-COVID Grand Final numbers, but it does depend on the cycle. But certainly it was a big lift from the weekend before, Graeme, so a big test for the market. And the market obviously passed that with flying colours with another strong clearance rate. Melbourne's actually been the great survivor in a sense through this period, this winter period when rates have been rising and confidence has been falling. It's really maintained weekend after weekend that low to mid 60% clearance rate. And other factors which we'll look at shortly are correlating that consistency and the sense that the Melbourne market, might just start to pick itself up earlier than expected this year. And we may start to see prices not just levelling off, but maybe a little bit of growth towards the end of the year.
Oh, no, heck, don't be silly. That's not going to happen in this economy. That's not going to get us on the news anytime soon, Doc.
Well, no, it'd be shock horror, wouldn't it, in reverse? But certainly the Melbourne market has been resilient. As I said, it's working around about neutral at the moment. The latest prices that we are tracking show that certainly price declines are starting to improve. In other words, they're not falling as fast as they were in Melbourne and Sydney too. But Melbourne's now heading back to more of that neutral environment. Now, as the auction season progresses through the last quarter of the year, Graeme, we do tend to see lower clearance rates because we have more stock in the market. So that may put some downward pressure on clearance rates, but so far so good, particularly in that Melbourne market. And it really would have been almost a shock if we started moving up towards 70% clearance rates by the end of the year. But Melbourne's certainly sticking its head up as the big improver, and really it hasn't fallen away as much as many were predicting. And as I said, it has a rest this weekend, just a handful of auctions because of the AFL Grand Final. But the reverse of all that, Graeme, is that we have a big Super Saturday in Sydney. Of course, there's a public holiday and the NRL Grand Final in New South Wales the following weekend. And that, again, is the same scenario. Sellers avoid the clash with the holiday and the finals. And we'll probably have around about 800 to 900 auctions in Sydney next weekend. So as it was with Melbourne last weekend, it's a big test for the market. Whether they can absorb that surge in listings at the same mid 60% rate. So, stay tuned for next week's report, Graeme, because all will be revealed in terms of that Sydney market. But no doubt so far so good. And if we look at the other markets, Brisbane actually picked up in terms of its auction clearance rate at the weekend. It doesn't have quite as strong as an auction culture as we've discussed in Brisbane compared to the other capitals. But nonetheless, that's still a reasonable result. But Brisbane typically rotates around the 50% mark for auction clearance rates. It was very strong last year, and that was driven, as we've discussed, by that surge in migration out of the southern states through COVID. But it's sort of normalising itself now, Brisbane. But Brisbane is, I guess, just having a bit of a pause, catching its breath, Graeme, after a extraordinary period of growth last year, so no surprise. But Adelaide remains number one market in the country, Graeme. It consistently produces clearance rates around 80% every weekend.
Looking over the last month, Doc, you've had 70%, 80%, 83%, 89.5% last week. It's on the up and up.
Well, it is, but it just has maintained its position of strength, where there is certainly a lot more buyers than there are sellers in the Adelaide market. But we've got to remember that Adelaide is a very affordable market. It used to track very closely to Brisbane generally, but it's Brisbane median house prices are now broken away from Adelaide. So Adelaide still represents pretty good value to the locals in terms of that relative affordability advantage that it does have. But it's had spectacular growth over the last year, Graeme, and that acts to push buyers out of the market because they just can't afford to keep pushing or to borrow to keep up with the market, because their incomes are steady compared to where interest rates are going, and we know they're going up.
And Canberra's sort of settling down a bit. We've seen it have a little bit of a decline in its auction clearance rates, but still steady, still over 50% just.
Well, Canberra's in that recovery phase, Graeme. It's very similar to the Sydney market in many respects, its cycle. But very strong growth last year in Canberra. It is in pause mode, I guess we could say, currently. But we know that Canberra market is chronically undersupplied, so it won't take much for it to be back up and running again. But no surprise, it's settling at the moment, given how strong prices grew last year. And it is those big two markets, Melbourne and Sydney, and I mean in terms of size, that are now showing real signs of consolidating and improvement over winter. So it'll be very interesting to see how the next few weekends pan out through this football final public holiday period, Graeme.
Now, Doc, let's jump away from the footy and the big Super Saturdays. Let's talk about the economy in general. Let's talk about our wages and our inflation and GDP and jobless and all this stuff that most people don't really understand. But let's break it down for them. What's happening with our unemployment rate? So to give some context here, I read a very interesting article 2 days ago that said to the effect of, there's 474,000 people on unemployment, but there's 480-something thousand jobs listed.
That's
right. In other words, if they all qualified for the job, it's zero unemployment and we're still short. And I've just seen an article this morning that Crown in Sydney, that big whole new complex at Barangaroo, are closing Mondays and possibly Tuesdays because they can't get hospitality staff.
Wow, that's amazing.
So you imagine the overheads of that facility only trading 5 days or 6 days per week because they cannot get staff.
Yeah. Well, it says it all. I mean, we had the unemployment numbers out recently, Graeme, for August. And even though the unemployment rate ticked up a little bit, up to 3.5%, it's still an extraordinarily low number. These are record low numbers. We're not alone here. Most advanced economies have similarly very low unemployment rates. I think we're getting to the bottom of the unemployment cycle, Graeme. Our unemployment rate picked up because we actually brought more, our participation rate increased. So more people from the population came into the workforce and we couldn't quite absorb them all at the same rate we have been doing. So I think we're going to flatten now around the low threes in terms of our unemployment rate, mid threes going forward. And of course, that's basically the plan of the Reserve Bank, because if we are short of workers, Graeme, it means that bosses have to pay more for wages. And if you're getting a big pay rise, well, you're going to go out and spend it, aren't you? Yep. And that'll mean higher prices because there's still that shortage of supply to match demand. So we are in a good position. Our unemployment rate is spectacular. I think that even though it has picked up a little bit, it will remain around about where it is, I think, for the foreseeable future in the mid threes. But I think that that's, a good thing in a way, as long as our wages don't break out as they have in other similar economies. And that's if we look at wages growth in Australia compared to other similar economies, Graeme, we can see our wages growth is well below the wages growth of, well below their wages growth. But it's no coincidence that our inflation rate is also well below those other economies as well.
I was going to say, Doc, the UK and the US have got wages growth that's almost double us.
Yes.
But their inflation is not quite, but almost double us as well.
Double us, yeah.
Yeah. So there you go. We don't want that wages prices spiral, as you always refer to, either.
That's right, Grant. And that's the jeopardy here, is how to control wages. I mean, real wages are falling because inflation is rising faster than wages. So that means we've got to dig into our pockets a little deeper if we're not getting a big pay rise. And that's why the savings rate is falling. It's still quite high, our level of savings. So we've still got some savings packed away that we've had during COVID, but we are starting to spend it now, the savings, just to keep up with higher prices. And that can only go so far, of course. But, we've discussed that the early signs are that inflation is improving. We know that house building costs were a significant factor in pushing up inflation in Australia over the past year. At their peak, they were higher by around about 30%. But now we're starting to see the first signs that the growth in house building costs is falling. Not the actual growth, but the growth levels are falling. So it's still rising, Graeme, but not rising as quickly as it was. So that's a good sign, because inflation, as we always remind everyone, is not about the level of prices. It's how prices are growing. So it's the level of growth. So if we can see declining growth in the big drivers of inflation, that means inflation won't be pushed upwards because those factors are rising. And of course, the other important one this week, again, to mention is the price of oil, Graeme. And the price of oil is now well below its peak of earlier this year. We may even get the price of oil below $80 US a barrel going forward. And that would be good news, because we could start looking forward to, and we all know that, we look at the Bowsers now and they're $1.50, $1.60 a litre, whereas, earlier in the year they were $2.20, $2.30 a litre, depending on where you live. So that, again, is an important factor in inflation, that we've seen falling house building costs over the past month. And we're seeing the price of oil also falling, and the trend is certainly downwards. Now, the price of oil can be quite volatile, Graeme. We need to put a bit of a disclaimer in that one. And if it goes down over a quarter, it may rise over the next quarter, which will again work its way into inflation. But so far, so good in terms of those numbers. And we can sort of add to the interest rate equation there, Graeme, because the Reserve Bank Governor, Philip Lowe, was speaking to Parliament last week. This was sort of well reported. He made a couple of very interesting comments, which I'm not sure we'll go into, about high house prices, which just had me shaking my head. But anyway, the interesting thing, the really interesting thing he said was he believed that interest rates wouldn't be rising as quickly as previously thought, and that even though there are more rises in prospect, that he didn't believe they're going to be as strong as they have been with the current data. So that was some good news there from the Reserve Bank Governor, who again dabbled his way into saying, he said, I don't do house price forecasts. And then he went and did a house price forecast.
Yeah, so I'm not going to comment, because it'd be about a 2-hour rant. I don't do that, but this is what I think's going to happen anyway.
This is the forecast, but it's not a forecast. So don't worry about that.
Maybe it's just a personal opinion.
Yeah, but still a forecast, isn't it, from the Reserve Bank Governor? I mean, it was all over the news. He said that he didn't. He felt he wouldn't be surprised if house prices fell by 10%. From peak to trough. And he said, well, that's not a forecast. I'm thinking, well, hang on. Of course, everybody was then running with the Reserve Bank Governor says house prices will fall by 10%. Kind of carries
a little bit of weight when the Reserve Bank Governor makes commentary such as that.
Yeah, but then he says, but it's not a forecast. But the last time he made this non-forecast, he was forecasting not forecasting a fall of 15%. So
and in that same period, where did we get to?
Yeah, well, this was recently, Graeme. He was talking 15% in this cycle, or his comrades at the Reserve Bank were. and now it's 10%. So I guess that's a good sign, and maybe sort of reflects on what we've been saying in terms of perhaps some backtracking coming sooner rather than later in terms of those, outrageous forecasts of house price crashes. I mean, this year we'll see the housing market, national housing market, I reckon down by about 4 at this stage. So,
and Doc, in that summary, you've probably got Brisbane still up, Adelaide up.
Yes.
Brisbane up, Adelaide up,
Perth up,
but then you probably got Sydney, Melbourne.
Yeah, well, it's steadying Melbourne.
Yeah.
But the national house price is really all about Sydney and Melbourne, Graham. I mean, that's
purely on population.
Weighted average. When there's no such thing as a national house. Do you show me where the national house is, right? I mean, but it's just
you mean my house in Wagga Wagga might not go down 15% like Philip Lowe said? It could be different to Sydney. Oh, okay. All right. Different strokes for different folks.
Yeah, and the actual measures are all about Sydney and Melbourne because they make up, the vast the majority of activity. And, of course, a weighted average is based on, the number of sales. And Melbourne has the most sales, followed by Sydney. So that whatever's happening in Melbourne and Sydney, and we know that Melbourne and Sydney have been leading the market downwards through this correction environment. That's what the national house price is, basically. So you can have a poor performance in Melbourne and Sydney, and the national house price is also having a poor performance, but you might have a strong performance in the other capital cities. So it really is meaningless.
So, Doc, I want to throw a viewer question in for you at the moment. We always go to some viewer questions. So I've got one from Lisa this week. And Lisa this week wants to know, do you believe there's any opportunity with all the media headlines and the clickbait at the moment? Is there an opportunity to be purchasing a new home or investment strategically while everyone else is sitting on the fence? So I guess, is it a good time to buy, really, is the question from Lisa.
Well, the point is that, all housing investment, realistically, Graham, is a medium to long-term journey.
Yeah, we almost get the same questions each week, Doc, but they're just wrapped differently. We need new questions, ladies and gentlemen. Sorry, Lisa, but we need new questions. Stump us a bit.
And the point to that is, Graham, if you treat housing as some sort of an investment, a shorter-term investment play, you've really got to pick your timing absolutely perfectly, because it's not just about the turning of the cycle. It's also about all those transaction costs you've got to pay. It's no good buying and selling property over a 6-month period, because you've got to pay stamp duty, you've got to pay agent fees, you've got to do all those things, which are very, very expensive. So you have to have that built into your transfer costs if you're thinking about a shorter term play in the housing market.
You know what might be a better idea, Doc, than trying timing the market? It might be better to spend time in the market.
Yes.
For a medium to long term. That's probably better than timing the market.
Well, we know that most homeowners spend at least 10 years in the houses that they buy, each house. And of course, investment properties work, the longer you're in them, the more returns you get. And I mean, what a great environment, notwithstanding what's happening with prices, for investors, because we've got rents going through the roof. We've never seen rents this high. We've never seen rental growth this sharp, in a normalised cycle. We're starting to see house rents tapering off, and our latest data shows that that's consolidating, that we're seeing house rents finding, a peak in the shorter term. I think that's just because, tenants can't afford to pay as much as, at these high rental prices for houses. But the other end of that, Graham, is we're seeing rents for units continuing to rise. So I think there's a lot of
unit rents jumped about $20 a week in the last week in Sydney, and I think they were $5 or $10 in Brisbane.
Yeah, I think particularly Brisbane, which is its unit market, is very tight at the moment. Well, they're all tight at the moment, with the exception perhaps of Melbourne. But the Melbourne vacancy rates are falling steeply. Still over 2%, Graham, but they're well below where they were a year ago. And of course, Melbourne will be, we would expect, the big beneficiary from migration and also international students. So they've got to live somewhere, and that's going to mean more demand. We're already seeing, which I think is a shift from houses to units, because units are more affordable, because people can't afford to rent a house anymore.
That's right.
So they're shifting across to units. So rents in houses are steadying at high levels, whereas rents in units are continuing to rise sharply. So again, that's good news for investors, and Graeme, if you're talking about waiting the market out, you get a really good yield now because prices are lower, but rents are higher. So that's actually pushing your yield up. As an investor, you obviously, although it might be questionable, you obviously tie your tenant into a lease. So it's very difficult, obviously, to sell a property if it's under a lease, unless you're selling it to an investor, because you have to offer. So, it's not about picking the time in the market, Graeme.
No.
It's about your personal circumstances, firstly. I mean, if you see the house you love where you want to spend the next 10 years in,
well, that's your home.
Family, that's right. What are you going to care if you're paying, an extra 40 grand or you have to take a hit of 40 grand on your trade-in because you're going to trade up and probably get a discount. And all those ups and downs won't mean a thing in 10 years' time because it'll all be, completely irrelevant. You think about when you bought property 4 or 5 years ago, Graeme, what the actual transaction environment was at that time. It's all irrelevant. It becomes irrelevant after a year.
That's right. And you're always going to spend more when you're emotionally attached to your home. Now, Doc, the big elephant in the room I wanted to finish off for 5 or 10 minutes today is Queensland Land Tax, the new legislation. A lot of people are freaking out. A lot of people are saying, I'm not freaked out. I'm just going to put my rent up to cover it. But then people are going, well, hang on, rents are already through the roof in Queensland. What's your take on this? How do we break this down for mum and dad who, and I've tried simplifying this, people saying it's based on your land value, not that, so they need to understand the land component. But I don't want to get into a political thing because I know what I think of this stupid crap, but what are your thoughts on this? How do we break it down for mum and dad?
Well, any interference on the cost side in a business, and, investment is a business, has its ramifications. I mean, we're in a global inflationary outbreak that we haven't seen for decades. This is a very serious environment. Now, the more you raise costs, the more there's the capacity to offset those costs through, either higher prices if you're a business or searching for higher wages if you're a wage earner. And all that does is fuel inflation. This is the point. This is very serious business inflation, Graeme. It can be very tough to control. Now, I say we're the lucky country because we're doing better than most, but let's not, sort of stuff it up by, working to change our wage setting system or also increasing taxes and costs to the point where they can be passed on either, by an investor putting up rents in an environment where they're going through the roof already and will only cause misery and hardship, and also cause, more bids for higher wages, or the offset for that is if you're a home owner, that you cover your increased costs with a pitch for higher wages. And again,
but the only outcome from this Queensland legislation is inflation. People needing higher wages, people charging higher rents, and people trying to recoup this new tax.
That's right. But I mean, it may be about the state government being in a position where its budget is, under some stress. So it has to think about ways of improving its bottom line. But this is all a cost. And at the end of the day, Graeme, it becomes a political decision. If people don't like it, they vote against it.
Yeah, true. But it does feel a little bit like, to the average person, it's kind of like the bonfire's raging, if we call the bonfire inflation, and they're standing there throwing a jerry can of fuel at it.
That's right. Well, this is just, it's common sense, Graeme. And,
hang on. Common sense isn't all that common. We can't use that phrase anymore.
Yeah, look, the point is that real wages are falling already. We've spoken about people are delving into their savings. That's fair enough. They've still got reasonably high levels of savings particularly through the COVID handouts, and because Australians generally are quite a prudent attitude towards their personal balance sheets. But we've got this very low unemployment rate. You mentioned poor old Crown can't have to close some days because they can't find staff. And we see that everywhere. I did 3 gigs last week, Graeme, and at all of those, at 3 gigs I did last week, I spoke to people there. I spoke to 2 employers who said they're spending all their time looking for people because people are leaving. And then I spoke to another one who was one of the organisers, and she said, well, see you later, I've found a new job, you know what I mean? And I'm off. So it's everywhere, this, job trading environment, because we don't have enough labour to fill the positions. And that's what you said at the beginning. We have fewer unemployed than we have vacancies, for jobs in the economy.
Yep.
And yet, in this environment, it means that the worker has all the leverage. So it means if the worker is confronted with higher costs, then they have the capacity to say to the employer, well, mate, I want to have a higher income to cover these extra taxes and charges I've got to pay, So there we go. And the employer says, well, okay, I've got to pay it because I've got to keep myself in business. So I'm just going to have to whack up my prices to cover my increased costs, and on it goes.
Yeah, that's it. Well, summary, although we're ending on a bit of a concern there around the tax issue there and the land tax, is low unemployment, lots of work if people want it. We've got an inflation rate that's much stronger than everyone else. Interest rates settling down. We're not that bad, Doc. But hey, if you're listening to us and you're tuning in week on week, you can check the show notes for Doc's LinkedIn. You've got the podcast, the YouTube. You've got enough data here live each week, ladies and gentlemen, and context from Doc and I to make an educated, informed financial decision for your family. So don't get stuck in the clickbait. Don't get stuck in the headline. Doc, brilliant as always. Thank you. And we'll see you next week.
Yeah, it's going to be exciting news as usual, Graeme, I'm sure.
Always is. For us anyway. Thanks, Doc.
Thank you, Graeme.
Well, there we have it, ladies and gentlemen. Brilliant and informative from Doc Wilson, as always, and sometimes not too bad myself. Hopefully you found that extremely informative. And for those of you who are tuning in regularly, don't forget to check the show notes. And if you are looking for a bit more financial education and financial literacy, and you'd love to spend 2 days with people like myself and Doc Wilson and chartered accountants, etc., I encourage you to go to money-mentor.com.au, and I'd love for you to be able to use the discount code podcast1500. That's podcast1500, and you'd be able to spend 2 days with people like Doc and myself. That's usually $2,000. It'll be just $497. So have a look at the show notes, ladies and gentlemen. Look forward to seeing you soon.